The return of risk. Whether you're trading stocks, commodities, or currencies, one thing seems certain. Volatility is back.
We're going to have volatility.
The type of volatility that we are seeing on the upside in the stock market show up on the downside.
Dramatic volatility.
More volatility.
It's going to become more volatile.
Lots of volatility.
Pretty much every strategist and investor I've heard and economist is really expecting more volatility this year.
Now here's a look at the VIX, our so-called fear gauge, our favorite measure of volatility. Today we're back around 20. Last time we spiked this high was in October. Seems it sort of had something to do with Ebola. There was a big pop in treasuries. Hard to say. Who knows? So what's the reason this time?
Greece is certainly part of it, especially if you look at the European markets yesterday. Most of the benchmarks there were down more than the U.S., and really banks in the lead there. So that is showing a lot of concern about Greece. That said, in the U.S., oil really is probably the main focus for most investors. It reminds me of a great line Laszlo Barini had during the financial crisis. He said, everyone's waiting for the other shoe to drop, but this market's like a centipede, so we don't know if it's the 90th shoe or the 12th shoe. And really, that's the case with oil. You know, this is a major capital markets event. Yeah, it will be good for the economy in the long haul and consumer spending, but you have to worry about, you know, some sort of disruption in an oil-producing country. Obviously, we've seen dividend cuts and capital-raising efforts by some of the smaller energy companies. Right. So there are certainly a lot more shoes to drop.
Okay, so if volatility is back, how do you want to play it? Here is Julian Emanuel from UBS on surveillance this morning.
It's going to become more volatile. So investors have to have more patience. They have to have dry powder. They have to be buyers of dips. It's completely consistent with this divergence between Europe and the U.S. and this whole idea that you have a threat to European growth at the same time the Fed may begin raising interest rates. And so, you know, perceptions of risk may change. And you look at January, there are a lot of uncertainties.
A lot of uncertainties indeed. A Greek exit from the euro, the price of crude, how low will it go? It all spells short-term pullbacks for Goldman Sachs' chief equity strategist, David Kostin. He happens to have the most bearish forecast of all the Wall Street strategists we survey. There they are, and there he is all the way down on the bottom left, 2,100 on the S&P 500 by the end of the year.
Right now, the sentiment indicator that we use, looking at futures positioning data, is at an extreme of 100. It's been there for basically the past month. And that would suggest over the next 4 to 6 weeks, we would look for a pullback in the market. In fact, that is what we've seen already at the very beginning of this year, something in the order of 2 to 4% over that period of time. So that's a near-term tactical positioning in the market likely to go lower. If you look at the broad trajectory, you mentioned some of the ISM data. Basically, the economy is growing. In our view, the economy is growing at over 3% for this year, and earnings will be rising. And as a result of that, we anticipate the market basically moving higher to the middle part of the year. And then as we look towards the latter half of 2015, we'll have the Fed hike, and as a result of that, likely to get a PE compression. At the end of the day, you end at a 2,100 level, which is only modestly above that, looking at roughly 5% total return, including dividends.
Well, it sounds pretty simple when you put it all like that. But as of today, there is another big fish out there who is suddenly a lot more bearish. In his new outlook today, Bill Gross, now of Janus Capital, writes, quote, when the year is done, there will be minus signs in front of returns for many asset classes. The good times are over. Well, I suppose that's true, unless you're planning to vacation in Europe. In that case, you're probably still in a pretty good mood.